In this video, traders, we're going to look at different ways to get long exposure to the stock market. Stay tuned. Hey guys, warm welcome to you. So really for investors or traders, people who are looking to get exposure to the US markets on the long side, i.e. as the market increases, your portfolio or the valuation of your investment will increase. So there are certain ways of doing it. Some are more suited to certain types and ideas and themes than others, or certain kind of goals, investment goals than others. I want to look through just some of them here now. So if you're looking to get exposure, just standard long exposure to the S&P 500 and other markets, but use the S&P 500 as an example, then this is the kind of video for you. All right, so you've made done your due diligence, you've done all your research, and you've decided that you don't want to buy a basket of stocks. You don't want to go down the stock picking route. You just want to buy and get exposure to the US market, specifically the S&P 500. You believe that's broad enough, and you think over the next however many months or years or decades that is going to appreciate. So what are your options? Okay, so before we go into some of these ones here, you can of course go to a fund manager and then you can buy a tracker fund. Many of the big funds out there operate a tracker fund, and you allocate your capital to the fund manager and they put them into a tracker fund. The fees of those are low, but they're generally not going to be as low as some of the other things we'll discuss here. But that's one method of doing it. To a big fund and you say, hey, have you got an S&P 500 tracker? More than likely they go, yes we have, and you can give it to them and they'll deal with it. So there's a bit more kind of work they do for you. They help you out, and perhaps they add some more value somewhere for that increased fee, but there is that. But apart from that, these are the things that we can do as a DIY perspective, if you like. All right, so the first thing is we can buy ETFs. Okay, so ETFs, these specific ones, there are more and we'll discuss it in a second, but specifically SPY, IVV and VOO track the S&P 500. SPY is the most expensive, but it's the most liquid, and others are a little bit cheaper. You have to go and check out the exact price. I mean, they are very, very cheap when you compare it to perhaps other traditional funds that are trying to generate alpha. Very, very cheap, and it's an easy way of getting exposure because these will track the S&P 500. You buy them like you would a traditional stock. So you say, here, I've got $20,000 to spend. I buy $20,000 worth of that. You get a specific number of shares back, and you can track that very easily, and you're just watching literally a chart of the SPY, IV or VO, and you can get out of it very easily as well. No fees to get out, no fees to get in, apart from your traditional broker commissions. And again, we'll talk about brokers in a second. Very simple, very cheap, and a nice way of doing it. So you can scale in or out as well if you were using perhaps adding money monthly into it, or you wanted to scale out because you had to make a purchase elsewhere or divert assets. Very easy to do. Also very easy to see how your whole portfolio is performing. So you've got your SPY, you've got perhaps some shares as well, and it kind of all goes into the mix, and it's very easy visibly to see, okay, well that's what my return is, etc. All right, so the next one is to buy the futures. Okay, now this is probably the least attractive one for most people, because buying futures, and specifically there are different types out there, but the ES is the S&P 500 E Mini, which is kind of the most liquid one really. Won't go into the full details of it, but there's a commission to get in, the big commission to get out, and you can hold that future, but the trouble is it will expire and you'll have to then open a new futures contract. So if you've got, let's say, a 2-3 year view on this, then that may not be the best way of doing it. Now, tax wise, that's going to be your own personal circumstances, where you live, etc., in terms of capital gains and how it's adjusted for stocks versus futures. There is some intricacies of that, but from a pure perspective of buying the futures contract, probably inconvenient for most people if they have a longer term horizon. Probably the least on. If you've got a short term horizon, then of course makes sense, but a longer term horizon, not so good. Okay, now we've got stuff that's going to depend on where you live in the world. If you're in the UK, you're going to have access to a spread bet. A spread bet is really to be able to bet on the futures without having to pay any tax. Some personal circumstances may differ slightly, but on the whole, most people who are buying a spread bet won't have to pay any tax. That's a fantastic way of getting exposure, purely if you expect to make a capital gain. And of course, we all do with traders, but if you're going to make a capital gain and there's a tax advantage of having a spread bet wrapper, that's a great thing for British, UK-based traders to do, because at the moment, at the time of doing this video, spread bettings are exempt from capital gains tax. So you can buy literally a futures contract, or you can buy something that tracks the S&P 500. There are different kind of names for it depending on which broker you're going on, but ultimately tracks. Now, depending on which one you're buying, there are some costs associated with that, and the advantage of this, or disadvantage, is that you can trade on margin, so you can trade a little bit more aggressively. If you've only got 10,000, you can maybe buy a little bit more, 20,000, 30,000, depending on the margin requirements at the time of the video of that exposure, so you can get more exposure. But that comes with a downside, is that you're going to have to pay for that facility every night or every quarter. You're going to have to pay to be borrowing that margin. So you might have to do a little bit of juggling there, maybe not use so much margin. Some brokers allow you to dial down the margin, so you've just got no exposure that way, so play around with that. But the tax wrapper is the kind of best advantage for that. I should have mentioned actually futures contract as well. You can buy a margin. ETF, you're buying for a long term, you might be able to get some sort of margin, but it's an easier way to get a clean kind of exposure. Hey, I got 20 grand, got 20 grand worth of stock back. CFD, same thing as a spread bet, effectively contract for difference. It's basically there'll be a contract that will track the S&P 500, and this is for kind of people who aren't based in the UK. You can trade on margin with that, almost identical to a spread bet, apart from the tax wrapper that it's in. Maybe an option for a lot of people. There are some charges if you're trading on margin of holding that stuff overnight and over a long period of time, so it may not be the most tax efficient way, or cost efficient way, should I say, of you holding something. If you have the money to hold something, you don't require the margin, you might not want to pay those fees. All right, so the final thing, guys, we've got is options. A couple of things you can do with options. You could buy a call option, which is basically a bet that the S&P 500 will rise. You have to pick your expiry price and you have to pick your time. But if you've got a kind of idea of where you think the market could go and a time period of it, then you can select maybe a couple of options or one specific option, and that can give you many multiples of your risk payout. So it's going to be a different type of thing. You're not going to risk your full 20,000 on that, assuming we were investing 20,000 here. You're not going to risk your full 20,000, because the option, if it expires worthless, you lose a whole lot. So yes, whilst you would make an awful lot of money if it came in, you had a full 20,000 pounds worth of dollars worth of options, you're going to get stung. You don't want to get stung. The point of this is a lower risk way to play things. So you pick out a few call options. The other one, a bit more advanced, would be selling put options. So selling put options would not give you the full benefit of the growth, but if the S&P didn't do quite what you wanted, i.e. kind of stagnated for a year, you'd still get a payout from that, whereas these ones you generally wouldn't. So that's something to consider, to explore, possibly a bit more advanced, a bit more research needed. If you were just wanting to track and get long exposure to the stock market over a reasonable period of time without any significant costs involved, then from my perspective, an ETF is definitely the one to look at. A SPY, an IVV, or a VOO. Another thing you could also do, obviously, in UK, is have a look at doing some kind of spread bet. And if there isn't a spread bet offer that you particularly want, ring your broker. They're more than happy. They've got the facility there to do something. They might well say, okay, well, if you don't need the margin, then we'll do you a specific trade that will operate under these conditions, and you know, it helps them because it's the flow they've got in there on their order book. I know, guys, there's different ways to get long exposure to the stock market. See you next one. Bye bye.